Good morning and maybe good afternoon to some of you out on the East Coast. This is Kristen Burke, and today we are doing another webinar here with Larry Moore with National Guardian Life, and he's going to really talk about why to insure or maybe why not to insure. So this call should only last about 15 minutes. All of the lines are muted. If there is any questions, you can feel free to type them into the question bar in the GoToWebinar panel page there, and we can address those at the end of the call. Just keeping it really casual and don't want to take up all of your time here, so I'll turn it over to Larry. Thank you.
Great. Thank you, Kristen, and good morning, everybody. I am operating from a mobile hotspot, so I just want to confirm, Kristen, you still see the screen?
I do. Yep.
And it moved for you?
Yes, it did.
All right. I had a brief scare for a moment. Anyway, good morning, everybody. Sorry about that interruption. Kristen and I have been in this business a long time, and we're always trying to figure out, what can compel a buyer to buy or not buy, and quite frankly, compel an agent to want to engage in this product or not. Because the things we hear about is it's either too expensive, you can't get it, there's not a real good cost benefit or relationship with product and premium. And I think when I show this presentation to you today, I know it's helped me in a number of selling situations, basically the logic behind it. And I think it'll help you. It'll help you from the standpoint of feeling confident about engaging and selling long-term care insurance, and also being very forthright with your client about the value that long-term care insurance brings to the planning process. So from there, what are the objectives of today's call? Very quick, very objective call. We're going to compare the pros and the cons of self-funding versus leveraging long-term care insurance. And then I also have some numerical examples showing outcomes over a 30-year period. I'm doing a net present value calculation, if you're familiar with that, to demonstrate, the trade-offs between what the insurance delivers versus what self-funding delivers, and more importantly, what you would have to invest today to achieve the same objective that the insurance will provide you in 30 years at the level of premium outlay and investment. So let's get right to this. So first of all, start on the left side. The upside or the pros of self-funding. What would compel somebody to self-fund their future long-term care expenses? Well, first of all, there is no barrier to entry, no underwriting, right? You don't have to worry about that. Second, you have full control of your capital, which is great. In other words, I'm taking my capital, my investable capital, and I'm devoting it to this particular objective, right? I don't know why my PowerPoint is jumping around here, but it's weird. Hang on a second. Come back. There you go. And then finally, you still have the asset in hand, right? So if you set this capital aside, and then at the end of time, never needed long-term care, passed away, you do have an asset you can pass on, which is attractive. You have complete flexibility about who you pay and where you pay, right? It doesn't matter who's providing your care, if you want to pay that person, whether they're licensed or not, or where you receive your care, at home, in a facility, in a tree fort, I don't know, it doesn't matter, right? Full flexibility there. And then finally, you don't have to deal with the claims process. So there's a lot of attractive reasons behind why somebody might want to self-fund versus leverage insurance. So now let's look at long-term care insurance on the right side, right? The pros of leveraging LTCI. Superior purchasing power, pennies to dollars, as we like to say. In other words, the amount of premium outlay you make for the benefit size you get can't be matched. It's very difficult to match it unless you have a ton of money to just set aside for this one purpose. There's attractive tax treatment, right? In other words, the benefits from a tax-qualified long-term care policy, which is primarily what's sold today and what is offered by your folks as well, right? You have access to only tax-free products. It means that when I go on claim, not one penny of that benefit is considered taxable income, right? Businesses also enjoy unique tax treatment around long-term care insurance. IRS code 7702B, you see it there a couple times. They have the ability, based on their company structure, whether it's S Corp, C Corp, to basically deduct part of or potentially all of the premium outlay if they were to provide this product for their key executives. And at the same time, the benefits of the insurance remain tax-free to the policyholder. So this is what's weird. There's something going on here. Anyway, and then finally, there are also asset-based policies as well. Asset-based policies, I don't understand why this is flipping back and forth. Asset-based policies meaning life-based, annuity-based products which provide a death benefit. The premiums are guaranteed, and the premiums can be recaptured at the end of time if care is never needed. All right? So those are the upsides to both the self-funding argument and the leveraging insurance. And of course, with every upside, there are questions about what is the downside. Let's take a look at that next. So the downside, let's look at the downside of self-funding. The reality is there is the risk of financial priorities changing with that investment that you earmarked for long-term care insurance or long-term care funding. In other words, you set the money aside for your future care. All of a sudden, maybe there's a financial emergency and you need that money now to pay your mortgage, do whatever, right? Maybe there's a grandchild that all of a sudden got into Harvard and you want to help that grandchild go to Harvard and there's no loans available for that, whatever it is. The reality is that investment can be repositioned for other purposes, which means you could essentially unplug your LTC funding strategy with your own assets. You do have exposure to market risk and or interest rate risk, depending on the environment we're talking about. So it isn't a real bird in the hand necessarily unless you pick a real low rate of return investment that may lose the race against inflation. When care is needed and you need to start taking distributions from that account or liquidate from that account, that's a taxable event. So in many cases, what you have to do is set aside more than you expect for the cost of care to account for taxes, distribution costs like commissions to the broker, things like that. Likely with most people, they're going to ultimately underfund their actual care costs down the road because they don't have the money to set aside to match what the insurance could bring to the table. And then ultimately, and this is the biggest one, you can irrevocably impact your estate planning and legacy goals if you self-fund, use up that money set aside for LTC, and have to invade other capital expenditures in your investment planning and your legacy planning as well. So it has a very disruptive potential impact to your overall estate planning goals. That's the downside of self-funding. Downside to leveraging insurance. There is that barrier to entry we call underwriting. Probably 25% of cases don't make it through underwriting, right? So you have that reality to contend with. So if there are health issues, you may not have a choice but to self-fund. If care is never needed, if you have a traditional long-term care insurance policy, it's use it or lose it. While traditional LTC provides by far the superior amount of purchasing power of all insurance vehicles, it is, again, a use it or lose it scenario. So if you die and never needed long-term care, that investment's gone. Okay. With traditional LTC, historically, we saw the reality of the risk of rate increases. I don't think that's as big of an issue anymore because we now know the assumptions and new products are priced with proper assumptions around interest rates, morbidity, and other risk factors that have to do with claims cost, right? LTCI contracts are largely illiquid financial vehicles, right? They're not liquid until you file a claim for long-term care. And this actually goes to asset-based products as well. People ask me all the time, if I have an asset-based LTC hybrid that's life-based or annuity-based, can I get the cash value out of it? Well, here's the reality of those contracts across the board. The cash values are so thin in asset-based LTC that if you do borrow against them or pull cash value out of them, you will crash the benefit. So not a smart thing to do. And then finally, the final con of leveraging insurance is that you do have to go through a claims process, file for a claim, which means you have to qualify for benefits. So you do have some hoops to jump through with insurance that, again, you don't have to with self-funding. But those are the big ones. And I'm sure as you think about what I shared here, you may think of other smaller, more insignificant issues. All of that matters, because when we look at long-term care planning in an objective way, it's important that you understand the difference of the pros and cons between the two strategies. And there are strategies. You're making a conscious decision to either fund it out of pocket or leverage a financial instrument like long-term care insurance. So from there, let's go into some scenarios. We have about another 10 plus minutes and we'll be pretty much at the end of this. What I want to do is highlight a planning situation for a 57-year-old couple. I'm using Nebraska rates, right? On the insurance strategy, we just happen to be using a joint policy through NGL. It could be any contract you want. In this NGL policy, it has what we call the shared benefit amount rider, which is the third pool that both people can draw from. We're going with a $200 a day benefit, 3% compounded guaranteed growth, 90-day elimination period, or call it a deductible if you like, and that it's a comprehensive policy, meaning it pays for care in all avenues, nursing home, assisted living, home care. And the total premium outlay for this benefit structure, and it's a 3-year plan, right? Benefit structure is $200,640 over a 30-year period. In other words, the total premium outlay that this couple will have spent is going to be $200,640 by year 30. Okay? We're going to contrast that investment, if you will, to a self-funding strategy, and I have two scenarios. Scenario one, well, what if we took that $200,640 and simply invested it? And I'll be conservative, and we'll call it a pre-tax growth rate of 5% by, over time. What would that $200,640 look like in terms of purchasing power by year 30? You're going to find that we're going to be far short of the objective by taking that route. We're then going to contrast that with a second scenario. What would the necessary investment be today? If, in other words, what would we have to put down today to fund the same amount of coverage, if you will, that the insurance would provide by year 30, again, at a growth rate of 5% pre-tax, right? So those are the two scenarios that we're looking at. So let's get right down to some numbers. And before I do that, by the way, I want to define what our joint policy with the shared benefit amount rider means, okay? So that's why this is an important little graphic. So this is for that 57-year-old couple. You'll notice it's a joint policy, so it means both insureds have the same amount of benefit, $219,000 each. That's a 3-year benefit. And what they also have is a third pool added for an additional 28% premium. We call that the shared benefit amount rider, right? It's a better strategy than shared care that we see with other policyholders. But what that does, it basically adds a third insurance policy to the puzzle. So this couple, day one, for an annual premium of $6,688, has day one. The moment they sign on the application and they get the policy delivered, day one, they have $657,000 tax-free available to them. So I just wanted to make sure you were all clear about the structure of this strategy and how it works. And I'm happy to address any questions you might have about that if you have any. So now let's take it to scenario one. Let's see what we have here. So looking at the left side of the grid, left of the yellow demarcation point, right? So that's $66.88, that annual premium. Year one, out the door, I have that day, for this couple, $657,000 tax-free available to them that day, right? If you contrast that to the right, if we said today, I want to put $200,640, that's the 30-year duration of what that premium would have cost. What does that look like day one? Well, it looks like $200,640. You'll see on the right side, right? So right out the chute, I have a significantly better position for an incremental investment with insurance. And running down the left-hand side of the column, by year 10, I will have spent over $66,000 in premium for this couple, but my pool of money will have grown to $882,942, right? By the time I reach year 20, so this couple is now 77 years old, they will have spent $133,760 in premium, but look at the overall value of their benefits, over $1.1 million, almost $1.2 million in tax-free benefits. And then finally, by year 30, they're 87 years old, they will have spent a total of $200,640 in premium to gain almost $1.6 million in tax-free benefits, right? A lot of leverage there for what you get. And you look to the right side, we made our initial investment of $200,640. We took what that premium investment by year 30 would look like and let it ride at 5%. And by the time you get down to year 30, you'll see you're pretty much at a shortfall compared to what the insurance would provide. So for instance, compare the out to by year 10, my insurance benefit value would be $882,942 compared to $327,546. In other words, that $200,640 grew at a rate of 5% pre-tax. And I will tell you the key word is pre-tax, because again, you start taking distributions out of that money or liquidate the accounts to start funding your care, you have to pay taxes and distribution expenses as well. By year 20, you compare $1,186,650 in tax-free benefits to a taxable distribution of $534,263. And then finally, by year 30, you see it, right? I would have had almost $1.6 million in tax-free benefits with insurance versus my investment would have grown to a little over $870,000, all taxable, right? So that's scenario one, if we took the total premium outlay and just let it invest. Now, the question is, that's great, but what are my other objectives, right? Well, let's take a look at that. See, we just talked about scenario one and what scenario one results in. Ultimately, we see our shortfall, right? $870,984. Let's go a step further. What if we looked at a scenario where, what would I have to invest today at 5% rate of return in order to derive what the insurance would deliver over 30 years, right? Well, out the chute, year one, again, $6,688 gives me day one, $657,000. To match the benefit at the end of time by year 30, I would have to reposition $368,000 of my liquid estate towards long-term care. And again, still be at a significant shortfall day one. However, running through all the numbers, let's just go straight down to year 30, where I spent in premiums $200,640 to get 1.5, almost 1.6 million in tax-free benefits. Well, repositioning 368,000 gets me almost to the same point, just a few dollars short, right? So that's the leverage picture we're talking about. If you're going to fund this out of pocket, when we conclude, the scenario, let's just go right to it. There's your investment to match the insurance, and we would only have a shortfall out of pocket of $397. So that's the trade-off. And this is where you need to kind of put your mind when you think about long-term care planning, because there is a cost-benefit reality. There also is the reality of health, whether you can qualify it or not. But I think it's important to just keep in mind, what does it take to beat the insurance if I don't want to buy it? What would I have to do? And if I choose to go that route, what are the impacts financially, right? that therein lies the story, Kristen. So any questions on this?
Perfect. No, no questions at this point. Just that, yeah, the leverage is huge, and I love the shared benefit. That's just an awesome rider that, you know, couples can add on to their policy, and they don't then, once, you know, one is utilizing their benefits, they need more, they can go into that third pool and not interrupt the coverage that is set aside for their spouse. So that is
Right.
just, I love that. You know, you're really the only carrier that offers anything like this. So nice.
We are, yeah, and you know, one thing to keep in mind is that this benefit can be structured in such a way that you can sell a shorter duration policy. So for instance, if insured one uses his benefits up in 3 years and he still needs care, he's got another 3 years available to him. In other words, you could have a 6-year plan. You know, that's the beauty of how that's structured.
Exactly. And not to put you on a spot, Larry, maybe you can't share, but is there any exciting things happening with the long-term care with NGL this year?
Well, I will say that we've made some administrative improvements at the level of billing. In other words, we combined our ACH process into one page, which is nice. We do have on the drawing board for filing a new product, but you won't see it until the end of the year. I think you'll like what you see there. Other than that, we're in just a good position financially, and kind of we're seeing the business just steadily grow with us because more and more people are beginning to discover that for couples, we seem to be the best place to go.
I agree. And I mean, you have probably, have you had 2 claims come through so far? I mean, it's just been very small.
Oh yeah. Yeah, our this is what's interesting. And you know, you and I have been in this business for decades, right? The fact that we only have 2 claims on the books, and when we entered this marketplace, we were priced for a terrible interest rate environment. Witness where we are now. We're very profitable. We're very happy where we are, and we just don't have to deal with the legacy business that all my competitors have to struggle with. You know.
Right. Yep, I agree. So, well, great information. I've had a few people ask if the presentation would be available, so we can definitely send you a copy of the PDF of the presentation for you to have. And I'll talk with Larry to see if we could do another call. I think that people have found this information informative, so we'll find another quick, fun topic that we can discuss maybe in about, you know, sometime in June, have another webinar. So yet June is right around the corner. It's tomorrow. So, but
crazy. Yeah, crazy.
It is. So, but okay. Well, thank you, everyone. And if there's any questions, you know, feel free to reach out to your marketing organization or to myself, and we can definitely help you. So thank you, Larry, so much.
Thanks for having me. Have a great day, everyone.
Thank you.